Good evening. My name is Susan Moon, and I'm the Executive Director of the Walnut Creek Library Foundation. We are happy to present this year's spring presentation of our pandemic postponed annual series of investment, estate, and trust programs that are designed to help educate our viewing audience with timely and practical commentary about subjects that we must all pay attention to. I'd like to thank our Finance 101 series sponsors, Kathy and Jerry Hicks, for making these programs possible. We are delighted to have professional advisors located here in Walnut Creek offer their time and expertise in these subjects. The Walnut Creek Library Foundation raises funds to provide free programs and add to the collections for our two Walnut Creek libraries. We're kicking off the Finance 101 series with a presentation on the possible effect that the new administration in DC has on investing. Our next program on March 25th will be a discussion of life insurance and why it is important for business people and families with children. The third session on April 8th will discuss Medi-Cal planning and special needs trusts. These topics are useful for all families that have aging family members and those that have special needs. And finally, we wrap up the series with a program on how to access Medicare and Social Security programs on April 22nd. Our speaker this evening is a longtime friend of the Library Foundation and has presented financial updates for our Finance 101 series since its creation. George Nassetti holds a master's degree in education, an MBA in business, and is a licensed financial advisor with Morgan Stanley and a registered retirement planning specialist, as well as a family wealth advisor. You may have seen him on Bay Area TV and heard him on radio. He's on KCBS Weekly, is a frequent financial commentator on Fox, KTVU, ABC, KRON, and KGO radio. Following his presentation, we will have a brief Q&A, and you are invited to submit your questions in the Q&A box at any time. Please join me in welcoming Morgan Stanley's Family Wealth Advisor, George Nassetti.
Hello, Susan. Hello, everybody. Thanks for having me. Walnut Creek Library, very, very special place, and I think we should all do what we can to keep it a special place by volunteering, contributions, and maybe making presentations from time to time, as I'm doing today. So glad everybody could make it, and we'll do our best at the end to try to answer your questions. But we really have a lot to talk about before we dive into the economic forecast. So what I want to do is I want to take you a step back. I want to take you back to the future. I want to take you back to January 2020. Sounds like a long time ago. A lot's happened economically, politically, and in our environment. And life was good. January 2020. Unemployment at that time was at 3.5%, lowest it had ever been since World War II. Black men and women had experienced lower unemployment, not spectacular, but lower unemployment than we've ever had in the 5 and 6% range. Women made a contribution to the workforce in a significant way. 51% of the workforce in January was made up of women entering the workforce, continuing the workforce. And so that was really fantastic. We were also averaging in January, pre-COVID-19, we were averaging about 200,000 new jobs a month in our economy. That's net of jobs lost and jobs gained, 200,000 a month on average. We had 144 straight months of continued job growth. There was pretty much a job out there for almost anybody who really wanted to work, which means that people had the means then to, provide for food and shelter, their homes, their families, et cetera. And then all of a sudden we started hearing about COVID-19 and the world started to really change on us. We had, February, we were told we got to, stay at home, shelter in place. We were ordered to do that, February and March especially. We got in our cars, we went down Main Street past the library. There was nobody out there. All the stores were closed. We were all ordered uniformly in the United States to stay home. And if you had to work, you could work from home, but that would be about it. So that was unusual. That caused an economic recession. This happened very, very quickly. In January, we were getting our gross domestic product results. And we saw really since the prior year, late in the prior year and in January, our GDP, our gross domestic product, which is a measure of all our buying and selling in the United States, not our imports and exports, but just our buying and selling here, we started to see the numbers go down. So from an economic point of view, we were looking at probably a recession occurring sometime in 2020 at the end or beginning of 2021. Would have been a mild recession because our economy was in pretty good shape, but it would have lasted probably a couple of years. But instead, with this pandemic, which was very unusual than any recession that we had, it caused us, because we didn't know how to deal with it, have everybody stay at home. And because of that, our $22 trillion economy went to zero beginning in February and March. And all of you can recall the stock market on March 25th, the Dow went down to 35%. Now you know that because you looked at your portfolios, your 401k plans, your IRAs, and you saw the value of those go down significantly. You could have had a drop anywhere from 20 to 30 to maybe even 40% in your portfolio. We manage a lot of money in our practice at Morgan Stanley, and clients that we continually communicate with on a normal basis, they called us up. They were worried. George, should we get out of the market? And of course, our advice is, you don't get out of the market. We've been through these economic recessions before, and we've been through my major stock market swings. And our advice was such because when you get out of the market, you bake in a loss that you can't recover from. But those that stayed in the stock market when the economy stopped saw their portfolios in the last 12 to 13 months grow for anywhere from 10 to really up to 50%, numbers that we never see. But this recession was different. It was caused by a healthcare disease that caused deaths and caused people to get sick. And so we had to shelter ourselves. And because of that, all the economy stopped, and that caused our first quarter GDP of 2020 to decline by about 5%. Now that wasn't too much, but in the second quarter, the gross domestic product declined by 35%. And when that happens, when you have 2 quarters that are negative, that's a definition of a recession. So this recession lasted the first and second quarter of the year until June. And then from an economic point of view, we started to see a V-shaped recovery. Now, starting in June and July, people really questioned whether this was a V-shaped recovery or not, but it was, because in some ways we learned really how to work at home for those folks that could do that. But many people weren't able to do that. The industries that were really hit the hardest was the leisure industry, the hospitality industry, and the retail industry. When we look at all the unemployment that occurred through our studies at Morgan Stanley, only about 10% of the unemployed were from the higher income group, about 20% from the middle income group, and about 65 to 70% in the lower income group. Those that were hit the hardest, people that work in these boxes. And when that happens, those individuals at the lower income levels, unfortunately, don't have IRAs and 401k plans and sick leave benefits and those kind of things. So they were pretty much at zero. So when the economy stopped and the lower income group was really hit the hardest on this, many other people were able to work. Most of the professionally skilled workers had to be at home, but they found ways to work at home because a lot of their work can be done professionally on Zoom, on the computer, and people adapted very easily. In fact, it was a forced learning situation for business, showing them how people could be productive working from home. So many of the professional people were able to continue with their incomes. And the interesting part of this phenomena that occurred as we look back is that people with higher incomes also have 401k plans and IRAs. And so they were able to keep their income, and they were also able to grow their 401k plans and IRAs. They were able to get wealthier. But the lower income folks, which was 70% of the people that were laid off, besides not having an income, they didn't have a 401k plan or an IRA. So we're seeing a big spread now of incomes. There's more people growing at the high income levels. The middle class has been really shrinking, and the lower class has been growing. And I bring this up because this really hurts our domestic economy. Our economy works better when everybody is out there, working and buying things and consuming. So the people that had incomes and stayed home, they didn't spend any money. And that's why you're seeing a lot of statistics come out about savings rate was really, really, really high. And that's why with the vaccines coming out and people being able to get back to work, we're seeing a lot more green shoots in terms of the economy growing in a lot of the sectors. So on the unemployment side, we pretty much had about 20 million people that officially were unemployed in the States. There's also another unofficial amount, which is probably another 15 million people that have just exited from the workforce because they were older, they were fearful of COVID, they decided to retire and get out of the workforce. So the unemployment was really, really much, much greater. We got the unemployment rate was up to about 15%, and now it's hovering really in about the 7% range. But still, the group that is unemployed is the lower income group. What we're starting to see now in the economy as we go forward is we just had a jobs report that came out in February, and net we created about 385,000 jobs. Now that's not enough because we still need about 10 million jobs really to provide more employment for other people that have been put out of work. So we have a long way to go in that. So the other thing I wanted to quickly mention is that we had other things happen in our economy, not just the layoffs of work, but we also had a lot of social unrest. We had the George Floyd demonstrations, and that was really fueled a lot by people just not being able to provide for their families, to be able to buy food and shelter. When that happens, people act in a different way, and it escalates problems that we have that we have to solve. So we had to deal with that issue during the year. And then also we had the election, which also can create some volatility in the stock market, in the economy, because you just don't know who's gonna get in. And it was a very fierce election that occurred. It started off with the Democrats getting an array of candidates, and Joe Biden, of course, who was elected, was down pretty low in the array of candidates. But through the debates, we found out that the Democrats have a side of the party that's liberal, a side that's conservative, but the middle part of the party is more moderate. And that's where we saw the dark horse, Joe Biden, really move up ahead of Bernie to the lead. And that's because he was more moderate. But he had a party, of course, that he has to satisfy that is liberal on one side and conservative on the other. But as the election, started to draw down, as you know, it was very controversial. Obviously, I think about 95% of the people believe that it was a fair election and it was a legitimate election, but you still have part of the population that doesn't really support that. So, we have a lot of social unrest, we have a divided nation. And what also happened was that as we move towards our electoral college, it was likely that the Democrats would win the House again, retain the House, but they would probably lose a majority in the Senate. Ironically, through the Georgia vote, which we all followed, 2 Democrats moved from the shadows and won that. And so that gave the Democratic Party fewer seats in the House, but still a majority, which is significant. And also in the Senate, they were able to get a divided Senate, Republicans and Democrats, with Kamala Harris having the tying vote, which can't be used all the time. So this actually may have worked better for the nation to have a Democratic Party that will have to be more moderate. They will have to reach out to Republicans in order to get them to agree on issues and things that are important to them. And so if the Democrats had also won the House outright and the Senate, they would be able to push any agenda they wanted. But that would create, of course, more divisions in our nation. And so maybe in the long run, forcing the Democrats and the Republicans perhaps to work together, let's be positive about this. Maybe we can, make something very, very, very positive happen. So this really sets the scene now for the Democrats to take a more moderate position going forward to get their agenda put together. We also had the attack on the Capitol Mall, which again is comes from a lot of unrest, dissatisfaction, and some people are just plain bad, and others are just feel like they're not included in society, just like with the George Floyd incidents that occurred. So these are real social issues that are starting to percolate, getting worse, and they have to get solved in order for the United States to have a good functioning economy. So what we're really looking at now politically is Joe Biden and his first 100 days in office. Uh, there's a whole theory that goes back to Roosevelt. Wilson was the president, and in his last term, uh, he handed Roosevelt a depression. So Roosevelt, to get us out of the depression, he had to go to Congress and get appropriations of a lot of money, which he was highly criticized by doing that. But that helped us get out of that depression, and that led the way for his first 100 days to be successful and for him to get his agenda moving forward. Biden's got a similar situation here. His first 100 days, unless he solved or solves COVID-19, it's not going anywhere. Whether it was anybody who was in office at that time, this economy cannot move forward if people cannot go to work. And COVID-19 being as serious as it is, and all the people that have died as a result of it, and the people that are ill, and people that are just worried about being in crowds and working and going into stores and restaurants and traveling on airplanes and that sort of thing. Any president who has this, his first charge really is to, get vaccines in the arm, reduce the frequency so that we can get more comfortable going out into our environment. And so, as of yesterday, he was able to get the American Secure Act passed, and I'll talk more about that in a minute. It's 1.9 trillion. It's a lot of money. When you plan these programs, you plan way in advance and you come up with a number. But fast forward, there is a camp that believes that it's too much money. 1.9 trillion is too much money. And that's because we're starting to see some economic results, some green shoots, which I'll discuss in a little while and show you some charts on that, where our economy is really improving. Because the reality is the majority of the people are working. People with higher incomes, are working and have the money to go out and purchase things. And so it is really important for Joe Biden, as he implements this $1.9 trillion program, that he puts somebody in charge of it that will micromanage it and make sure that the money is put to good use. Otherwise, he will be highly criticized by the opposition party and the people that also support that party. So it's really, really important that he get off to a good start with this funding, and that he really does get the vaccines, which it looks like it's happening, in the arms of individuals. When that happens, and we can feel more confident, confidence is what also drives consumption in the economy and helps your portfolios to do well. If people aren't confident, they hold on to money. That's been what's happening right now. There was more money in savings since World War II. We've never seen this much money in savings. And we also found that in the first CARES Act, a lot of people had a little bit of money to cover them for a month or two. So some of that CARES Act money went into individuals at the lower income, into their savings. That was criticized, but unfairly, because everybody needs to put away money for that event that is dramatic, and we need to pull cash out really quick. So that was okay, but people were criticized for doing that. And the bill they thought was too rich on the opposition side. They had CARE Act 2, which came in late, not until December, and people were really struggling. That money was essentially spent because people, especially at the lower income, had run out of money at that particular time. So the pathway is clear. If the vaccines get in arms and looks like the money's coming, that takes a big weight off of Joe Biden and the Democratic Party. This really clears the way for that political party to focus on the rest of their agenda, which is the voting rights bill. They want to get that passed. That actually benefits the Democrats in so many ways also. So there'll be opposition to that. They want to increase in the minimum wage. So this is kind of an interesting topic. Minimum wage is $7.25. The federal government raised the minimum wage 12 years ago. So if you've got the minimum wage at $7.25, you haven't gotten an increase in 12 years. And I don't think anybody, to a person, would like that. That's not good. So as this becomes a bigger and bigger problem over the year, it becomes more and more political, of course, with the agenda is to raise minimum wage to $15. Now, I will tell you that 22 states right now are paying over the minimum wage. And there are some states that kind of got it right. They came up with what they thought was a fair minimum wage, and they've indexed that to the cost of living, which I think is a phenomenal idea because then it takes away all the politics. You come up with a number, just like Social Security. You come up with a number and you increase that by the cost of living, and you don't have to really talk about it anymore. So I think what's really going to happen is the Democrats kind of let that, didn't fight not including the minimum wage into the American Secure Act, the 1.9 million. And I don't think it really belonged here. I think it's kind of a separate subject. But this clears the agenda for them to do that. Because it's so highly political, it's likely it won't be brought up this year. Next year, we're getting towards midterm elections. And if Biden is successful in the first part of his agenda in the first 100 days, then possibly they might attract some more Democratic seats in the Senate. And that would allow them to really push through a minimum wage, which that would help raise poverty by an unbelievable amount, move people out of poverty and help them have an opportunity to get closer to a fair wage. Now in San Francisco, the minimum wage is $14 an hour, and next year it's going to be raised to 15. But if you live in California, California defines that if you make under $40,000 as an individual, you are considered low income. So even if you're getting the minimum wage at $15 an hour, if you annualize that, that's about a $30,000 salary. So, we have a long ways to go to make sure that people have a living wage doing real work and helping to do that. So it's likely that that could happen in his second year or maybe after the midterm elections if the Democrats are successful in retaining the House and gaining more seats in the Senate. But it depends on the performance of the Democrats. The other big issue right now is immigration reform. And right now we're having a problem with children coming across the border. And it's just a lot to handle when somebody starts in their presidency without having a good running start to try to get all the policies in place to do that. So that'll be a troubling, for the Democrats, that'll be a troubling issue that has to be handled. And then, of course, there's the environment and climate change. And Biden was able to sign off on joining the Environmental Act with really Europe to try to work together on that together. You're finding that a lot of companies really are going green. They know that investors want to invest in companies that have fair hiring practices, have less of a carbon footprint, companies that are environmentally, socially concerned. I have a lot of clients that when we talk about their portfolio designs, they say, I don't want any gaming stocks in there. I don't want any companies that abuse people. I don't want companies that have a carbon footprint. Now, some oil production companies do, but they're also working on getting green. And that's part of a green strategy to support companies that even though they're making a negative environmental impact, if they're pulling back and getting better, we really should support them. That's just one line of thinking on socially responsible investing. But that will be a big push going forward for this year and next. And then we have, of course, healthcare expansion. It's not going to get worse now, but it may get better. It may be more inclusive for people. The problem we have with having healthcare for everyone is that it's very, very expensive. They're able to do this in other countries, in Europe especially, and that's because they've socialized their programs. Okay, in the United States, we don't want to do that. We want to have a choice of any doctor, any hospital we want to go to, and we want to get multiple checkups if we feel we need to do that. But in other countries, when you have a socialized healthcare program, you're really restricted and limited. That's why it's really hard in this country to get a program like that. And if you do, it is very, very costly. So cost is really, another factor that the Democrats are going to have to balance with healthcare expansion. But that is that's there. Then also, what the Democrats want to do going forward is to, build back better, an infrastructure play. Little known fact is that infrastructure play is about a $2 trillion charge to do that. Now, infrastructure generally, when you put out money to do that, you're funding it with debt, but then you also get people working and you get a payback on that particular debt also. So the problem we're having now is that all these expansions and programs and efficiencies that we're trying to do, they cost money. You know how much we have spent since just for the pandemic alone, and how much more we're going to spend to get this economy on track. If we were going to do it, now's a real good time to do it because the interest rates are extremely low. We will have rising interest rates. This will happen. And when we do, it'll be very, very hard to fund additional debt. It'll become a larger part of our gross domestic product. Right now, our debt, which is we got about a $22 trillion economy, and our debt's about $22 trillion. And our debt service, the expense that we pay on the debt, is about 5 or 6% a year. We spend about 60% of all the money coming into the government on Social Security, Medicare, and Medicaid. Those programs are really expensive because, again, they're not socialized, so they are going to be more expensive. But that's where a main part of the budget goes. And then 15% for the military. You have the debt service, and then we have another 15% that we can spend, to run the country. And that's why we run into a deficit, and that's why we're having this issue of trying to control costs. And COVID-19 didn't help with that. That's something we just have to pay for, and hopefully provide safety and health for people as soon as possible. So taxes. So taxes probably, what we're going to be seeing is that they're probably not going to be increased in this year. It's going to be the real focus this year is really the COVID-19 and getting the economy going. Taxes early on could really slow down our recovery as it is, but taxes will come. We will have to pay more taxes. There'll be more corporate taxes. That'll be first on the agenda. And personal taxes will go up for people making over a certain amount of money. That number is a number of 400,000, but it will vacillate all over the place. So those are just a couple of things that I just wanted to mention first off before we move forward and talk about what we think is going to happen going forward. So a lot has happened to us since January 1st, beginning of the year, and the recovery on this is going to take a lot of time. But luckily, inflation is really low right now. But eventually, we will start to see the ugly hand of inflation, rising as we start, making money a lot tighter here. So with that, let me see if I can put up our PowerPoint. This will just take me a moment to do that. First of all, the political outcomes since January have led to our U.S. policy strategists at Morgan Stanley to expect, and I'm making a change here. We thought in February it was going to be about 1.5 million in COVID relief in a stimulus package to get our economy going again. Instead, fast forward, it's signed at 1.9 trillion, which is just amazing. And so this is going to help the reopening. It's in progress. Vaccines are ramping up. It'll be pushed down to the younger people. And people are starting to get back to work. So we saw basically in our last jobs report that we saw just last week, we saw an increase of about 350,000 jobs, a set of jobs lost, come back into the economy. So basically what we're seeing is that the stimulus has been lifting our gross domestic product. We had really 2 quarters. In the first quarter, as I mentioned, we had a negative GDP, and then we had a positive GDP. And so what we're really forecasting in 2021, by getting people back to work, we expect our GDP to be really at about the 7.6%, about the 8% range. And that's a phenomenal recovery, but we're coming really from a really lower place. We're seeing the buying power of U.S. households soar this year as the government transfers rebate checks. We're seeing people moving back into the job sectors. One of the phenomena that happened is we found that we can have people, work from home and be productive. A lot of people that have been able to buy homes have been buying homes so they can have an office space in there, they can have an internet connection. At Morgan Stanley, our office is closed right now due to COVID. We're starting to reopen slowly when the vaccine gets out there. But financial advisors are able to do all their work, from home. We're online. Everything is real time. Stock market quotes, all the trading, talking to clients and using Zoom. So we're seeing, things start to move forward. We're seeing that the job gains, the unemployment rate, which was really at about 20%, is coming down to about 6.7% now. And in 2021, we expect it to be really at the end of this year at about 5%. So just think about this. Just about 15 months ago, we had about a 3.5% unemployment rate, and that's the lowest we've ever had since World War II. And we're thinking that by the end of 2020, we can be at about 5% unemployment. And that, of course, is with people, getting the vaccine, going back to work safely, distancing at workplaces. But we're starting to see things, open up. And by the end of 2022, we should see the unemployment rate really drop to about 4%. So that's really good progress. It was a very, very quick recession, and we're seeing a very, very quick recovery, even though people are struggling, especially at the lower income levels where they work in retail stores and in restaurants. So we're starting to see people come back to work but working safely. And we find that, stronger growth also leads, to, higher inflation. We're seeing price adjustments, that could be increasing. But right now, inflation is still pretty low. And that's because, our taxes have been held down to some degree. But we'll start to see, core inflation move up. And when that happens, then we'll have to, react in a totally different way. So let me move on to the next one here. Great. Okay. So this is our forecast. Okay. So in 2019, our real gross domestic product, which is all the goods and services that are produced nationally, not internationally. In 2019, we were at about 2.3% GDP. And then in 2020, because of COVID-19, we ended up a negative 2.5%. That's because our first quarter, we were down about 4%. Our second quarter last year, we were down about 34%. And then in the third and the fourth quarter, we saw, an uptick because we learned how to work, under COVID and how to start making things happen. So our forecast for 2021 is about originally it was about a 7.6% forecast of GDP. But because we found that our economy is moving really a lot faster than we had projected, really looking at about an 8.1% GDP rate. And in 2020, so that'll be, pretty quick recovery for this year, but then things will slow down because there's been a lot of pent up savings and demand for spending. People have been stationed in place, working at home, and we haven't been able to travel. We haven't been able to do the things we like to do. So people have been saving, and the unemployment rate, for the higher income people, mid to higher income, has been, pretty secure. It's the lower income people that have really suffered the most. So in 2022, we're expecting, actually, we've adjusted this number to about 2.8%. And that's going to be affected by, increased sales growth. People want to spend, they want to get out there, and we'll start to see spending. Sales, we'll see that increase about 6.7% this year, and then things will settle down to about 3.1. And we're also seeing exports down at the bottom here. If you notice in 2019, it was about 0.4%. In 2020, exports were very, very low, minus 11%, but we're forecasting our exports to increase to about 11.6 for this year. And then in settling down in 2022 at about 4.5. Imports have decreased in 2019 and 2020. But again, in 2011, we're going to start to see more imports at about 11.9%, which helps our GDP. But then that'll settle down to about 4.7%. The core CPI, the Consumer Price Index, we're seeing right now for 2021 to be about 2.3%. We're probably not going to see heavy inflation for a long time. It's probably going to be lower for longer. And the unemployment rate, we're forecasting really for 2021 to settle in at about 4.9%, not the 5.1% that we forecasted a couple of months ago. And then in 2020, we'll be at about 3.9%, not the 3.5% that we were previously to COVID-19, but that's a darn pretty good number. So if we're able to achieve these numbers, we'll start to see the internal economy, start to roll back again. So in tracking the progress of the economy and the recovery, we look at things like real GDP. So we have a factor number here, based on 100, and in the first quarter, in 2020, we've only seen about 28.7%. But in the second quarter of 2020, when COVID really hit us, it went down to about 89.9% on GDP. But in the third quarter, we saw it going up to 96.6, and in the fourth quarter, up to 27.5. We're just in the new year, so we're starting to see an increase also. We're seeing, an increase in sales, domestic demand, private demand. We're seeing, more capital goods being purchased, going forward here, anticipating the recovery. We're seeing imports and exports both increase on both sides, and we're seeing federal spending, which doesn't go down too often, but going down a little bit here. So consumer spending, what really happened is with the amount of money that is being put into the economy. The first one we had was the CARES Act. That was the first one. And that gave people a pretty good lucrative that were unemployed, another $600 on top of what they were already getting. But the funding for that, came out of our deficit, and that was about $462 billion. And then we had the Emergency COVID Relief Act, and that was in December of 2020. Okay, just a few months ago. That came rather late. Was held up in politics for a long time, and that gave people $300, not the $600, but $300 on top of what they were already getting. So total funding was about $120 billion for last December, and that runs out, in March. And so now we have our new bill passed. We'll talk about it in a moment. And individuals initially with the first CARE Act got about $1,200. And a lot of that wasn't spent. A lot of that went into savings, but that now has been spent because this COVID people have been out of work for a long time, especially the lower income. And then the Emergency COVID Relief Act, again, was late. And so on top of a weekly supplement of $300 per person of unemployment insurance on top of what they're already getting, they're getting another rebate of about $600. And so total funding on that was another $166 billion. Now, the additional stimulus now going forward is about 1.9 trillion, and that's going to that was a negotiated item. Okay, it was going to put $400 of new money in the pockets of people making lower income, but that's been reduced through negotiations to $300. Then on the that's going to come out to about, in total now, about $300 billion in funding that we have to come up with. For rebates on recovery, people are going to get $1,400, okay, versus the $600 that they may have just gotten. Again, people are fearful of getting back to work because of COVID. Many people have died here in the United States. Many businesses early on could not open at all or reopen, such as restaurants. There's partial opening to those sorts of things. And so total funding for that is about 300 to 450 billion dollars in order for that additional stimulus to happen. So surprisingly enough, that's been signed into a bill now. We thought it was going to be about 1.5 trillion, but it's at 1.9 trillion. And there are pros and cons to this. Early on, 1.9 versus on the budget and what needs to be happen looked pretty good, but we're having a much quicker recovery than we thought we would with COVID, with all the businesses closing down. We're looking at who it's affecting, how much it's costing people. And so there's always an argument, is this going to be too much money? And but right now at this point, while we're not in favor of any kind of deficit spending that's going to go to the deficit, the cost of funds now is pretty low. When inflation really hits, cost of funds go up really high. That's really a problem. So the whole idea is to really get this economy, back on track before we have that kind of a problem again. So more stimulus means more buying power to fuel up, pent up demand. And so the 1.9 trillion is going to be going to putting money in the pockets of people. And again, this is affecting more people at the lower income side that are making in the range of about $70,000. And so we expect that really to be spent and put back into the economy. And that will increase, some disposable income that will actually, help the spending pattern and getting people back to work. There's also a forecast as we progress through the year. We expect the pre-COVID spending habits, will begin to return. People start spending again and propel the shares of services spending forward in 2021. While durable goods spending should revert back to their pre-COVID spending, people are going to be able to focus more on the necessities and also, things that they like services and things like that they need to have going forward. Now, inflation, we've had significant price adjustments that have come into effect because of the, inflation that could continue or get higher. But we really don't see that really growing out. We had a stronger January and February than we actually expected, which has not been creating, it's been keeping inflation down low. And we think it will, continue to happen for quite a while going forward. Inflation has really a lot of room to run. Our core consumer price index really moved from, we expected to really see inflation go from about 1.4% to really, when we get to the end of 2022, rise to about 2.9%. So we don't think we're going to have runaway inflation yet, but at some point that will happen. And so the whole idea is to get the economy, solid right now so that we can go forward in a much more positive way. So here's our projection at Morgan Stanley for inflation going from January 2021 on to December 2022. So we see inflation getting up to the 2% level, but really, not getting really close to the 3 or 4 or 5% that we thought may be happening. Because our economy was in pretty good shape prior to COVID-19. We just have to put together a larger deficit, which is, we're going to have to pay back at some point. But right now, the cost of the deficit is actually fairly low at this point in time. So in terms of the monetary policy, we really find that some sectors really have a lot of room to run, and they've been doing really well. If you look at the stock market, you see the stock market be very euphoric. And that's because the market is a forward-looking indicator. And while the economy and the stock market are really two separate things, the stock market has a forecast that, in the future, these prices will be able to maintain themselves. So by the middle of the year, we expect the cloud of COVID will have, thinned out, and the recovery will have picked up, and there's pent up demand for spending. We don't expect the Federal Reserve to really increase the rates till we probably get to about 2 to 3% inflation rate, and then we could see them start to raise inflation or the cost of funds, a little bit higher. So I think they're going to let the economy run hot. When the inflation gets over about 2.5%, you'll start to see some controls coming in. You'll see the tax rates go up. You'll see the cost of funds going up, and you'll see kind of a pullback in terms of the low interest rate that we have right now. But despite the upgrade in our inflation forecast that we have, we expect the Fed to not to really raise rates really in a strong way really until the third quarter of 2023. We've seen rates run a little bit. We've seen the 10-year bond go up to about 1.5%. Money's been pretty much free. We will see it go up a little bit, but the federal government wants to get this economy running and people, back to work. That's really the most important thing here that they have to work on. So employment and the Fed. So right now, you're seeing the unemployment rate, really pretty high. It's affecting women a little bit more than men. The age groups are really the younger groups affected, the most. The less educated you are, the more opportunity you have to be unemployed. The number that we have unemployed right now, a majority of those people are at the less education. We've been able to do some workarounds for other folks, but this economy works better when everybody is participating, when we get our unemployment rate down to about 4%. So, looking ahead to the pace of rate hikes, really what we really don't see happening is we don't really see taxes being raised this year. They will have to be raised. We see it more raised really in the second year of this recovery. We expect to see that happen to help fund a lot of the programs that are really going to be happening. So right now, the federal funds team is made up of presidents and representatives, but right now they're very dovish on raising the rates. You got to get the economy going first, and so there's really been a pullback on raising the rates. So the rates will be lower for a while, and then of course inflation will really kick in at some point, and then we'll see the numbers going up a lot higher. So with that, I think we can open it up for questions.
We have two questions for you. The first one is, why is my portfolio doing one thing when the market is doing another?
Okay, well, the stock market and the economy are two different things. The stock market is a forward indicator. It looks out into the future and it makes a bet. And it bets that your $10 stock is going to be worth $20 out into the future. The economy looks backwards. All the data that we have on the economy looks back. It doesn't look forward. It's backward looking results. But this recession is really different than any one we've really had in anybody's memory. The economy was doing okay. We were going to probably heading towards a slower recession out into the future. But the economy, there wasn't one thing in the economy like, back in 2008 when the economy tanked. It was really bad management, bad banking, putting out bad loans. It was a real systemic banking problem. And this problem is really no fault of anybody. So as soon as we can get people back to work, the economy is ready to get people back to work. And that's going to be getting more shots in the arms of people to get the vaccine so that we can be safe. Once we get some critical mass going, the economy will start to move forward again. There's nothing in it. We don't have a lot of issues or problems. We just want to get this thing going again. Okay.
Great. We actually had another question, but I'm not quite sure what it means. But Kathy wrote value versus growth.
That's a very good question. So for the past 10 years, growth companies have been doing really well, right? And so now we have to look at things differently. Like value companies, we think are starting to outperform growth companies right now. So that would be like your telecommunication stocks, your things that people are actually using right now, things that have a value going forward. But the tech, you're noticing a pullback in tech right now. Okay, and that's because people are not having to shelter in place as much now. They're going out. So there's less emphasis on the growth stock. Growth will still be there. Growth is still important, but we're going to see a real big upswing on value stocks.
Great. And our last question is, to what extent should the government intervene in the market?
Well, the government is intervening in the market, right? Because they are deficit spending all the stimulus for the economy. And they really have no choice. I mean, they really have to do that. This is happening really in all countries because of no fault. It's just an act of nature, this COVID virus. And so to keep the economy going, to people eating and doing, there's money being spent right now to do that. But we really saw a very, very sharp decline, but we're going to see a V-shaped type recovery. It wasn't quite clear a number of months ago, but it really is now that we're going to get the economy going again. And it's interesting because we'll see the global economy is all moving together. Everybody has had the same problem in Europe and in Asia. And so we've all been down together, but we're all working on this recovery together. So there's going to be huge, there's pent up demand for buying, and there's been a lot of savings, and that's going to help really stimulate the economy. The problem is we're going to have a lot more debt than we had, and debt has to be paid back. Luckily, right now it's at a low rate.
Okay. Well, thank you, George. Thank you so much for speaking tonight. And I just want to close out tonight by saying, and thank you everybody else for joining us. If you enjoyed tonight's program, we invite you to make a gift to the Library Foundation. You can click the donate button on our website at wclibrary.org or in the chat box, and know that your gift makes a difference. We hope that you'll join us not next week, but the week after on March 25th at 7 p.m. for the next Finance 101 program, Why Should I Own Life Insurance? Jane Vidal and JP McDermott of MML Investor Services will explain the many options to help you make an informed choice. And they'll share examples of how life insurance benefits you, your family, loved ones, and even business partners. More information and the registration link can be found at our website. Thank you again for attending, and good night.